basically, in a nutshell, I would term the supplementary budget as incredibly ambitious. So twofold, it is very ambitious, both in here and in the outer years, but also there's a big question mark about the credibility and the achievability of the numbers. So the purpose of the supplementary budget was to make in-year adjustments to spending. So basically looking at financial year 2020, 2021, and then also to give the broad framework for the fiscal position in the medium term. And here we see the focus was squarely on stabilizing the debt ratio. So the finance minister kept referring or threatening that there could be a debt crisis if cabinet doesn't do something. So in theory, the numbers in the budget document and the language used in the budget speech, I think, were positive, but in practice, and as usual, we face significant execution risk, particularly at a time when the global backdrop remains highly uncertain. So if we just kick off with a macro outlook, the government or the National Treasury did a mark-to-market, as we all have had to do over recent months. So in the February budget, the government was expecting growth of 0.9%. They have revised that to minus 7.2%. Not an outlandish forecast. Our own sort of calculations on a level of lockdown-based activity assumptions. So if you look at level 1, level 2, level 3, aggregating that, we think the hit will be slightly bigger at minus 10%. So the government's forecast does have downside risk, but as I mentioned, things are highly uncertain. So projections are very uncertain and the outcomes could be very wide. What we then look at is, because of the weak growth, you basically have a deficit, which would have been 6.8% of GDP, now running at 15.7% at a consolidated level. That would be the worst for the data we have on record. The pace of consolidation is much faster than expected. So while this year's deficit looks alarming, it is broadly in line with consensus expectations. But what we see is that the deficit consolidates a lot quicker to around 7 to 8% of GDP in the outer year. Our own analysis suggests it will be very difficult to get to a single digit deficit again. But if we look at the data, there are various policies that government would like to implement, even though this document remains quite vague on the details. If we look at the debt ratio, government has shown two scenarios. The one they call the passive scenario. So that's the do nothing scenario that we've had in many previous budgets over recent years. And there we see debt rising to 140% of GDP in roughly 10 years' time, which clearly is unsustainable, particularly if you're funding at 11% if you look at long-term bond yields. The active scenario, in other words, where government makes the difficult decisions to lead to consolidation, we actually have the debt ratio peaking at around 88% of GDP in fiscal year 2024. So to us, if they could achieve it, that would be a meaningful positive surprise. At this stage, we looking for the debt ratio to stabilize maybe between 95 and 100% of GDP. So again, Treasury in this document is sounding the alarm bells about fiscal sustainability and the risk of a debt crisis. But we have to admit that this time might not be different, because Treasury has been giving the rest of government and the politicians warnings since the medium-term budget policy statement of 2017. I'm sure we can all remember what we termed the Gigaba budget, when they sort of marked to market aggressively and in Treasury's words, told the truth. So we should maintain some healthy dose of skepticism with regard to delivery on these numbers. But what I found particularly encouraging was that this document explicitly states that Cabinet supports the active scenario. In other words, Cabinet is backing Treasury and the rest of government to implement the policies that would be needed to stabilize the debt ratio slightly below 90% of GDP. So what does this entail? So what we have in the current fiscal year is obviously the COVID response. So you will recall in April, government published the details of a 500 billion rand stimulus package. So what government is doing to fund it. So remember, the 500 billion rand isn't entirely a funding need. There's 200 billion, that's a credit guarantee scheme. Some of it is delayed taxes, so not taxes foregone. But basically 145 billion of the 500 billion needs to be funded. What they do is roughly 109 billion will come from reprioritizing spending within government departments or between government departments. Here we've seen certain projects which can be delayed, will be delayed. Projects that have been disappointing in terms of delivery will be cut. And that is actually quite encouraging, particularly given the uncertainty that remains leading up to the October medium-term budget policy statement. We do face a risk that there will be further increase in funding needs related directly to the COVID-19 response. The second thing is that we are facing an unprecedented tax collapse in the current fiscal year. So Treasury estimates the total to be 304 billion rand. So what happens after this? So Treasury will not be hiking taxes this year to try and make up the shortfall. That will certainly be nonsensical. But Treasury is relying on a rebound in nominal GDP growth with the normal multipliers to get nominal revenue growth sort of back on track. However, that will not be enough, and Treasury has penciled in roughly 5 to 10 billion rand per year in tax policy measures. Now, tax policy measures, that usually means a tax hike or a new tax in some form. We also have to admit that some of it may be related to SARS efficiency gains. So the fact that SARS is being rebuilt, becoming more effective, could lead to additional revenue intake without tax increases. A case in point is Judge Dennis Davies, who did all the work on the Davies Tax Committee with his teams, estimated that there is a revenue pool of roughly 50 to 100 billion rand per year that remains uncollected. So whether it's avoidance, evasions, etc. So if SARS can actually get their hands on that, that will delay or prevent the need for tax hikes. So what could the 5 to 10 billion rand be? It's very difficult to see that those would be on corporate. So the idea in the February budget was that we were going to try and ease the burden on corporates so that we could lower the corporate income tax rate so that we become more competitive. So our sense is that could be a personal income tax hike, which would obviously be negative for the consumer, particularly at the upper end, or small increments in the VAT rate. Now, we know that's been politically a very tough decision to make. There was a lot of backlash 2 years ago when Treasury did hike the VAT rate. So there's still a big question mark about what the revenues could be, and Treasury has not yet decided. That detail may come through in the October NTBPS at the earliest. Then we have to acknowledge that government will have to do a lot more on expenditure cuts. So in the February budget, Treasury indicated an aggregate of 160 billion rand in spending cuts via the wage bill. That remains on the table. However, because of this big gaping funding hole, government will have to cut a further 250 billion rand in 2021-22 and 2022-23. That's a substantial amount by which to cut expenditure. And if you combine that with the wage bill proposals, you're basically looking at a net drag from the fiscus of 3.5% of GDP every year. So that would be a significant negative fiscal hit to growth. Again, the track record of spending cuts we have to question, and the exact detail of how government's going to implement that will only be available in the October NTBPS. So what are the negatives? The negatives are obviously additional tax hikes on the cards in the next few years, and then there's a high risk of backtracking on the proposed spending cuts by the time October rolls around. One, growth could be even weaker, and two, we know the political climate is quite tense, and it's not obvious that there is broad agreement around the detail of the 250 billion rand. What are the positives? In our view, it is that Treasury is rethinking its funding strategy. As we have seen in the US and elsewhere, Treasury is relying a lot more on short-term issuance to plug the hole, so specifically increasing T-bill issuance, which makes sense if your repo rate is at only 3.75% versus your 10-year yield between 9 and 10%. Almost 100 billion rand equivalent will be obtained from international financing institutions. So the IMF, you've heard about the rapid financing instrument, which is roughly 4.2 billion US dollars, which will likely be made available to South Africa. And the news flow last week that government has secured $1 billion loan or facility from the new development bank. So that's the BRICS Bank. And also the government is drawing down on some of its rand deposits. Again, these are emergency measures, but would make sense given how high back-end bond yields are and how low cash yields are. In terms of domestic issuance, the market certainly took it as a positive surprise that the issuance metrics or projections mean that government will not have to increase the weekly auction size at this stage. There is a risk that they may have to do so around the October medium-term budget policy statement, but for now, the market can breathe a bit of a sigh of relief in that it doesn't have to stomach additional supply of paper. So what happened with regard to SOEs in the supplementary budget? Actually, very little. So Land Bank in particular received 3 billion rand in terms of an equity injection, and that's so that they could redeem bridging finance obtained earlier in the year. So even though the Land Bank's equity injection forms part of the COVID response, it actually relates to their downgrade earlier in the year and the liquidity problems they faced because of the downgrades. The 3 billion is still far short from what we've seen in media reports of the Land Bank maybe requiring up to 20 billion rand in shareholder support. SAA received nothing new. So in the February budget, the Treasury allocated 16.4 billion rand, and that's to redeem guaranteed debt on behalf of SAA. We know from the business rescue plan that SAA will require another 10 billion rand to implement the plan. Based on the timelines, the vote on the plan is today. So it could be that there was no explicit number assigned to SAA because the vote had not yet taken place. But we know the finance minister's bias has always been to close down SAA and restart new rather than trying to keep it running. So that remains a question mark. And then Eskom also received nothing. Already in the Feb budget, government had allocated 56 billion rand to Eskom. What was interesting in the budget speech is that Treasury wants Eskom to accelerate its unbundling and road to recovery plan, which is in contrast to comments from Eskom we heard earlier in the year that it might actually take a bit longer. So how have markets taken this supplementary budget? Well, the rand was rather unperturbed, traded broadly sideways when the budget numbers hit the headlines. And this morning it's trading in line with the global risk off being weaker in the face of concerns about renewed surge of COVID cases in the US and therefore a stronger dollar given safe haven demand. Equities also largely followed the global markets pattern. So trading yesterday similar to the S&P and this morning weaker because of second wave fears and the risk off. Whereas bonds actually did rally quite notably on the release, given firstly the faster pace of consolidation, the commitment to debt stabilization, and the fact that issuance will probably not have to rise in the short term. There are still many things that we need to debate. As I mentioned, execution risk is extremely high. Policy credibility is always being questioned, and they will have to wait for the October MTBPS. Related to the credibility is whether there's the political will to follow through on the commitments given by Finance Minister Mboweni yesterday. For bondholders, consolidation and debt stabilization will be very, very important. But I think we have to discuss or debate whether such severe austerity at a time when structural constraints on growth are so binding will actually make sense, or will they actually be counterproductive? So the question really is, what does this do for reform? So will this COVID crisis actually galvanize government and the politicians to make the difficult decisions on long overdue reforms? I think we can all agree that the momentum in terms of the reform agenda has been really slow. And that particularly relates to network industries. So if you think electricity, rail, ports, even the broadband auction, the spectrum auction has been very slow, and it's expected this year, but it's still a question mark. And then obviously freeing up space for SMEs to start creating jobs again after the lockdowns. Ultimately, it will probably be a bit of a blend. So you'll have some consolidation, some reform, even if it is sporadic and slow, and the risk of higher government bond issuance down the line. But I think in the short term, bonds will benefit or remain fairly stable because of the lack of issuance. But at the same time, the debt profile may put a floor under yields. So if National Treasury is able to walk the talk, and admittedly it is really a big if, then what you could see is if the debt profile becomes, or market sees this debt profile as realistic, then there'll be a substantial opportunity in long-dated bonds, because if you look at where SA's yields are trading relative to our peers, it is actually relatively high. But for now, we are neutral to cautiously optimistic on fixed income because of low inflation. So our expectation is that inflation will remain below the midpoint of the target band, so below 4.5% in the medium term. We expect the SARB could feel pressured to cut rates further because of weak growth and the large output gap. And then obviously we have to admit that yields are relatively competitive and pricing in some of the fiscal risk. Thanks very much.